The 39th Ordinary Meeting of the Association of African Central Banks begins in Abuja, Nigeria's capital city. Ghana targets to halve its fiscal deficit this year after its $980 million aid deal with the International Monetary Fund. Plus, Tunisia's economy grows by 1.4% in the second quarter of 2016. Hello and welcome. This is Business Incorporated coming to you live from Lagos. I'm Chimeze Obi Iwabu. Well, we'll begin here in Nigeria, where the 39th Ordinary Meeting of the Association of African Central Banks is currently underway in Abuja, that's Nigeria's capital city. President Muhammadu Buhari, who officially declared the meeting open, called for policy sustenance by central banks in the African region. The president also wants financial institutions in the region to play a key role in reducing illicit capital inflows, as well as the repatriation of stolen funds without unnecessary bureaucracies. The CBN governor, Mr. Godwin Emefiele, who's hosting the event, wants African Central Bank governors to collaborate on cross-border banking. The theme of this year's meeting is unwinding unconventional monetary policies, implications for monetary policy and financial stability in Africa. And Ghana is on target to halve its fiscal deficit this year after its $980 million aid deal with the International Monetary Fund, and that's according to the Finance Minister, Seth Terpker. His comments appeared designed to allay uncertainty over the deal that emerged this month when Parliament rejected a key component that was designed to promote fiscal discipline. The following day, the government suspended a planned Eurobond issue. The government issued a bill to eliminate central bank financing of the budget deficit in line with the requirements of the deal, but on August 2, Parliament passed the bill with an amendment allowing financing of up to 5%. Ghana's public debt eased to 63% of GDP in May from 72% at the end of 2015, while consumer inflation dropped to 16.7% in July from 19% in January. Terpker said, citing the impact of the deal that began in April 2015. And to global markets now, we're beginning from Europe. Let's cross over to Frankfurt. My colleague there, Conrad Busen, is standing by to talk to us. Good afternoon, Conrad. Our rating agency Moody's has raised its economic growth forecast for China to 6.6% for 2016 from 6.3% previously, and to 6.3% in 2017, up from 6.1%. What will this mean for the global economy and, of course, the emerging markets in general, considering China's position in the global economy?
Well, the ratings agency is quite clear what this means for the world economy. Chimmy, the agency Moody's has also raised its growth forecast for Japan, for example, and it says a better outlook for China would likely help to stabilize the outlook for emerging market economies as well. Moody's upgraded its forecast for the G20 emerging markets by 0.2 percentage points, each to 4.4% for 2016 and 5.0% to 2017, mainly of Russia's and Brazil's capacity to have its economies contracting less quickly, and also because it's more optimistic for China. That's very good news also for many emerging economies in Africa like Nigeria.
Right. I'm sure while the market is eyeing that forecast by Moody on China and, of course, Japan, they are also looking at the U.S. July 3rd minutes, which have been released. What new insights are investors and markets getting from that decisions, and what is the outlook for September meeting?
Well, what's becoming clear in these minutes of the Federal Reserve's Open Market Committee is that the monetary policy makers are still searching their way. They are looking for some kind of framework they can apply for monetary policy in the US. You know, by traditional guideposts, if you take, for example, the situation on the labor market in the United States, it's about time now to increase rates, but the overall global situation, especially in terms of growth and in terms of low inflation, is not something that really warrants increasing interest rates. It's becoming clear that most of the people making monetary policies in the United States think that interest rates are about to happen at least once this year. Some, of course, as always, believe that there are going to be two interest rate hikes in September and in December. November is not very likely because of the US elections, which are really close, and it's not likely that the Fed increases rates when the US are going to the polls.
Let's come back to the market where you're standing, Conrad. What companies are making news today?
Well, we are talking, or people here on the trading floors are talking about Cisco Systems. The systems producer has announced that it's going to cut 5,500 jobs. And it's going to start to sack all these people this fiscal quarter. That was a very surprising announcement. Nobody had this on the agenda, really, and it shows that the business at Cisco must have deteriorated quite quickly and quite considerably. Why then such a very disastrous announcement of job cuts? Negative news for Cisco, that is. Nestlé, the large company, the large producer of consumer goods, has a bit of problems in the United States. It's not problems, it has to spend too much money for marketing in the US in order to keep its market share. China has slowed down somewhat, but Nestlé in general, the business is very strong, and investors are buying the share today, despite the fact that Nestlé shares had hit a record high last week.
Well, thank you very much for those updates, Conrad. We'll sure keep an eye on those companies as they come up with their news and information coming from there. Thank you, Conrad. That was Conrad Busen, DWTV, Channels TV financial correspondent, reporting there from Frankfurt Stock Exchange. And we'll move on now to Asia. Japanese shares markets closed lower after exports fell for the 10th month in a row, thanks to a stronger yen. The benchmark Nikkei 225 closed 1.6% lower at 16,486.01. The yen rose again today, passing the key 100 level against the US dollar for the third time this year. Japan's broader Topics index matched the Nikkei's fall, losing 1.6% to end at 1,290.79. Other markets are also trading mixed after Federal Reserve minutes diminished expectations of an interest rate increase next month. Seoul's Kospi rose 0.6%. The Shanghai Composite fell 0.2% to finish at 3,104.11. Hong Kong's Hang Seng rose by 1%. Australia's S&P ASX 200 fell 0.5% to wrap at 5,507.80, despite better than expected data that showed the country's jobless rate fell in July. We're still talking about that Japan's economy. Of course, the import and exports tumbled in July at the fastest pace since the global financial crisis, with a resurgent yen and weakness in overseas economies weighing on overseas shipments, leaving the economy and the government more reliant on shaky domestic demand to drive growth. The 14.0% annual decrease in exports in July matched the median estimate of economists and was the fastest decline since October 2009, while the 24.7% decrease in imports was deeper than expected, widening the trade surplus to 513.5 billion yen, more than the forecasted 284 billion yen.
原油価格がかなり大きく低下してますので、そういう意味で
The price for crude oil is largely decreasing, which means that the import cost for fuel has decreased. making this the biggest cause for the current widening trade surplus. Exports have also fallen, and this has been caused by a strong yen. From a trade perspective, having both exports and imports falling and having imports facing a bigger fall is not very good for the Japanese economy, because it means that trade is shrinking. If the trade surplus keeps widening, it will trigger a stronger yen, which is something we need to be cautious about.
Now, with the increasingly challenging operating business environment, how can businesses develop winning strategies in turbulent times? Find out after the break. Do stay with us.